Burger King, 7 Mile Beach, Waterfront, Town Center, Walkers Road, and Red Bay.
BK got beef.
Money Sense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
Hello and welcome to Money Sense. I am your host, Emil Kalinowski, broadcasting live from the studio of Radio Cayman, 89.9 in Grand Cayman and 91.9 on Cayman Brac and Little Cayman. And today's show will focus on an urgent disagreement between global stock and global bond markets. We are also going to touch upon ongoing trouble at the world's most important bank, Deutsche Bank, record-long economic expansions, full employment, and fear. Now, as you've just heard, there are many disparate threads in today's show, and they seemingly don't have much to do with each other. Some of them are categorically polar opposites of each other. How can deep-seated fear and a record-long economic expansion in the world's largest economy go together? How can global stock markets be at all-time highs, signaling an auspicious macroeconomic future, while sovereign bond markets, which are also at all-time highs, signal that some terrible economic event lurks in the shadows? Now, it's not just me, as I've been called Dr. Doom before. It's not just me who's a little bit worried. The Economist, the magazine, recently wrote an article. It was a June 27th article, and they titled it, "The Global Economy is on Knife's Edge," meaning it could go both ways. And that's what we're going to focus on today, is the disagreement between global stock and global bond markets. Now, I myself am at a loss on how to present this paradox, so I turned to the experts for inspiration. Authors. How does one begin explaining this situation? And I thought, well, authors know how to do this, right? Imagine writing a book, the blood, the sweat, the tears, the swearing that it all takes, and then trying to convince your reader to join you and somehow capture the spirit of your book in the first sentence. How do you do that? Well, I guess first thing you need to do is get a great graphic design artist, because so many of us judge a book by its cover. But once you've got that compelling cover, then what about that first sentence? And it's a wonderful world of captivating first sentences out there, and I went looking for inspiration as to how I could explain this unique, compelling, and confusing financial story out there. And I will tell you that I did find something, and it's probably the most famous opening sentence out there ever, if we don't count, "In the beginning God created the heaven and the earth." So other than that, there's perhaps a sentence that we all will recognize that perfectly captures this moment. But you're going to have to forgive me, because I found a few others that I found were absolutely delightful. And if you wanted to do this yourself, there's a great site out there called Openings, that houses a collection of first lines from books, movies, poems, articles, and songs. It's great stuff. Here's just a couple that I found, and then we're going to go right back into the macroeconomic picture. My favorite was, "It was a bright, cold day in April, and the clocks were striking 13. Another one, "The cosmos is all that is, or ever was, or ever will be." Here's another one. "It was a pleasure to burn." And then here's quite a funny one. "It is a truth universally acknowledged that a single man in possession of a good fortune must be in want of a wife." Now, some of you may recognize these, and I will reveal where they come from after the break. But for now, let's move on into the finance. And here it is, the sentence that perfectly captures our financial situation presently. "It was the best of times, it was the worst of times. It was the age of wisdom. It was the age of foolishness. It was the epoch of belief, the epoch of incredulity. It was the season of light. It was the season of darkness. It was the spring of hope, and it was the winter of despair. We had everything before us. We had nothing before us. We were all going direct to heaven, and we were all going direct the other way. And of course, that comes from Charles Dickens, A Tale of Two Cities, well over 100 years ago. And he was talking about the French Revolution. We don't have anything as dramatic as that, but let's start with the best of times. What is happening right now that suggests that we are living through the best of times? Well, the world's largest stock markets are at all-time highs. The New York Stock Exchange Composite Index is 3% off of its all-time high. But it's not just the United States. London's Financial Times Stock Exchange 100 Index is only 2% off of its all-time highs. And then the European continent is pacing everyone, with the Euronext 100 only 1% off peak valuations. Very positive outlook. Great. Also, we have the longest expansion in economic activity in U.S. history. As The Economist, the magazine, recently wrote on July 2nd, they wrote an article about this, and they headlined it, America's economic expansion is now the longest on record. The United States have surpassed their previous record, and they are now at 120 consecutive months with no contraction in 2 consecutive quarters. But, we always worry about the United States because it's the largest economy in the world. But they're not alone. Australia hasn't experienced 2 consecutive quarters of economic contraction since 1991. The United Kingdom, not since 2009. France, not since 2009 as well. Switzerland, Germany, and Canada joined that list as well. Not since 2009 have they experienced 2 consecutive quarters of contraction. And here's the remarkable thing. If you broaden that out to the G20, which is the 20 most advanced economies, the streak still stands back to 2009. We haven't experienced a collective recession. Now, while that's remarkable, you can go even deeper. The OECD, which is an economic organization based out of Paris, who collects data and suggests various policies, they have a larger list, more than just the G20, and it includes emerging markets such as Chile, South Africa, Saudi Arabia, and such. Even if you include all the member countries of the OECD, there hasn't been a collective contraction for 2 consecutive quarters, which is typically how we identify recessions, since 2009. That's a decade. But that's not it. There's still even more positive news. At the same time, the world's most advanced economies are reporting the lowest unemployment rates in decades. Back to the United States. They are reporting an unemployment rate that has not been lower for half a century. Not since 1969 have fewer people been unemployed. The Eurozone did have a lower unemployment rate in 2008 than they do presently. And that was right on the eve of the financial crisis. But other than that year, the present rates are the lowest since 1990. And I'm sure they're lower even further back, but that is as far back as the data goes. The United Kingdom, they're reporting their best numbers since 1974. Canada has the best employment picture since 1976. And both the UK and Canada probably have better numbers going back even farther. It's just that that's when the data stops, is in the 1970s there. At least for Canada. Canada has that's when their data stops. So if you combine all the rich countries, just like we did before with the OECD, the rich world economies they are at all-time lows with unemployment rates since 1983. That's when the data was first collected. So this is an absolutely fabulous picture, or as Charles Dickens would have told us, the best of times, the age of wisdom, the epoch of belief, the season of light, the spring of hope, at least in a financial sense. But it is also the worst of times. It's quite the paradox. And leading the charge, making the case that there's something wrong, are bond markets, which are also at all-time highs. And I'm referring here to sovereign bond markets. And what that means is countries that issue debt. And it's those bond markets that I'm referring to. And the way we can see that they are at all-time highs is by looking at their yields. Now, the lower the yield, the higher the price. And so when we look at the world's 6 largest bond markets, which are in the United States, Japan, Italy, United Kingdom, France, and Germany, you don't have to follow politics too closely to know that these governments have promised more to their citizens than they can honestly pay, right? And yet each of these bond markets are reporting stellar sales of their debt. So on the one hand, each of these countries are certain credit risks. They've promised too much. But investors are buying hand over fist. Why? Well, because these are the deepest, most liquid, most easily navigable safe harbors for financial capital. The credit risk that each of these countries present is somewhere over the horizon. But what we see right now is that investors are buying today because they're worried about something happening tomorrow or next month, and they want to secure their financial flexibility. So they're getting out of positions that are difficult to sell, other assets, and they're moving into the most liquid, 6 most liquid markets in bond markets, in credit. And 3 of those countries that I mentioned are actually reporting negative yields, negative nominal yields, which is remarkable. And remember that expansion that we were referring to in the United States as well as around the world. Well, if we remember, The Economist did have that very nice headline, but then right below the headline about the longest on record, they said that the record-breaking boom has proved disappointingly weak. It is, in fact, the weakest of the post-World War II expansion. Whereas economic growth on a per capita basis for the last 120 months in America has been 1.5% per year. It used to be 3.3% per capita for all other expansions prior to the current one. So yes, it is the longest, but it is also the weakest. But the United States is not the only country that is well below trend. On this show on May 16th, we talked about 13 different countries spread around the world: Indonesia, Mexico, Turkey, the United States. It was a very representative sample. And how their GDP per capita trend is well below where it was from 1945 to 2007, right before the financial crisis hit. And ever since that point, from 2008 to present, yes, the numbers have been positive, but very meager. And we also discussed on that show that from 1960, I have data on a global basis, and we see that same phenomenon, very meek growth. As for the unemployment rate, at least in the United States, the labor force participation rate is at a level on par with the late 1970s, signaling that many have left the workforce permanently and are not counted in the unemployment figures. Yes, unemployment rates are extremely low, but so many people have quit looking for work that they're no longer counted. It's sort of a paradox. In the rest of the world, the labor force participation rates are a little bit more mixed. It's much more pronounced in the United States. Now, after the break, which we're going to go to in about 30 seconds, we are going to take a side because the bond markets and the equity markets are not the only markets out there. And there are other markets, credit, collateral, currency, commodities, and they are sending out signals as well. We're going to review those and lean to one side or the other. So please join me, and we will pick a side between the two. Thank you.
Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
OneTradeX knows there's more than one way to invest. OneTradeX is the Cayman Islands' only fully licensed online broker-dealer, offering discount trading services to individual investors and traders, hedge fund managers, and family offices. OneTradeX has the most competitive online trading prices of any offshore broker worldwide, with no custody or management fees, free demonstration accounts, and no charge to open an account with a $5,000 minimum deposit. Trade stocks, options, futures, bonds, and Forex. Learn more and open your free demo account today at OneTradeX.com. OneTradeX, the Cayman Islands' #1 choice for online brokerage. OneTradeX is licensed to conduct securities investment business by the Cayman Islands Monetary Authority.
Welcome back to the Business Buzz, the business topics that matter, an insightful and fresh take on a variety of issues. This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands and sponsored by OneTradeX.
And now, more Money Sense.
Good morning. Welcome back. This is Emil Kalinowski, and we are trying to decipher which market is correct. The bond market, which signals concern, or stock markets, which are signaling that the economic future is auspicious. Now, before the beginning of the show, I said I was going to reveal where those quotes came from, and the first one was 1984 by George Orwell. The second one was Cosmos by Carl Sagan. Fahrenheit 411 by Ray Bradbury. And the last one, Pride and Prejudice by Jane Austen. But back to the financial dilemma that we're facing. The two markets are in disagreement, equity and bond markets. But we can turn to other markets and see what they are telling us. Let us first turn to the rates market. And what we see here is that just last week, the market value of all bonds with negative nominal yields, negative nominal rates, reached a new record in market value at $13 trillion. Now, you don't have to be a financial expert to be suspicious of the words negative yielding bonds. That means that whoever issues the bonds, whoever buys the bonds, expects to make no money and is guaranteed a nominal loss. This doesn't make sense. You don't have to be a financial expert. It is Alice in Wonderland. And the more Alice in Wonderland we see in the financial markets, the greater the disorder. So we just reached an all-time high in negative nominal yields. Also, there's an inverted yield curve in 6 of the 7 G7 countries. Only Italy has an upward sloping curve. And inverted yield curves have long been a signal that some sort of economic distress is up ahead. Inverted yield curves typically mean that the near-term rates are higher than the long-term rates. And the long-term rates are where all the economic opportunity is. So if market participants are saying that the future, the deep future, where all economic opportunity takes place, is going to be worth less than present, they are expecting some sort of economic disorder to be approaching. And that's taking place in 6 out of the 7 G7 countries. So rates side with bond markets in this case. What about commodities? Well, they're also signaling concern. The World Bank, the organization, they provide a monthly summary, which they call the commodity pink sheets. And they look at commodities across, the precious metals and energy, industrial, grains, and so forth. For our purposes, we are interested in the commodities that are used for economic activity, and they are siding with the bond market. Energy prices have fallen for 7 consecutive months when measured year over year. Now, that's great for us as consumers, but it is a macroeconomic signal that future economic activity is in doubt if energy prices continue to fall. And that is confirmed by metals and minerals, things like aluminum, copper, and iron ore. The World Bank's pink sheet shows that they have fallen in value for 11 consecutive months, again signaling that there is a concern about demand going forward. So rates, commodities are siding with the bond market. What about currency? Well, there's any number of currencies out there, but we're going to go with the U.S. dollar as our guide. And the U.S. dollar is rising in value, and it has been rising since February 2018. Now, a rising U.S. dollar might be good for U.S. consumers, but for the rest of us outside of the United States, that is generally a sign of difficult economic conditions, or more difficult, or rising frictions. As the dollar rises, it becomes more valuable and dearer. And people that are performing economic investments are less interested in parting in these valuable assets in the dollar. Sure, they could invest in the future and earn a return, but if the dollar continues rising, that hurdle rate continues to get higher and higher, and it creates friction for economic activity. Because the U.S. dollar is the world's global reserve currency, the dearer, the more valuable it is, the more susceptible the global economy is to some sort of event, disorder, or slowdown. And the U.S. dollar has been rising since February of 2018. What about credit markets? Now, the more credit there is in the market, the more likely we are able to conduct some sort of economic activity, the easier it will be. And this favors equity markets. We do see in China that the year-over-year growth in easy financing has been increasing since the beginning of the year. And the same is true with U.S. banks facing the rest of the world and international banks using dollars, or at least for the last 2 months of available data, which is March and April. So credit markets do seem to be in favor. There does seem to be an increase in credit that does favor the equity markets. Now let's move on to another market, collateral. Collateral gets you access to credit. And it's much like when we go and we borrow, we have to put up some sort of collateral. In the wider global financial system, businesses, banks, they have to put up collateral, and the best, most liquid form of collateral are those sovereign bonds that we discussed earlier, and the most pristine format of those are U.S. Treasuries. And presently, financial actors are hoarding collateral. 6 weeks ago, one measure of collateral hoarding, which is the net treasury position of primary dealers, and primary dealers are banks from around the world that have been given the privilege of redistributing treasury bonds from the U.S. government to the wider public. So these primary dealers, which is just a fancy name for important banks, these important banks are not parting with their treasuries. They are not reselling them into the rest of the world. They are hoarding them. Now, one could say, well, that's because no one wants to buy these. But that's not what's happened over the last 12 years. We've seen a fluctuation that during disorders, during trouble, these important banks are leading economic or leading monetary indicators. And when they start hoarding, when they refuse to part with money, with collateral, that slows down the credit process and economic expansion. Well, I've been talking about the economy the whole time. Let's move into some of the most leading economic indicators. This is a strange one, but it's true. One of the best leading economic indicators in the world are Japanese tool orders. Japan is obviously an export powerhouse. Their business relies on customers from around the world buying their goods, and tool orders are a leading indicator for that business. These have turned negative year on year for 9 consecutive months. Germany, similar to Japan, also a leading economic powerhouse facing the world. New orders in manufacturing out of Germany have been negative for 10 months in a row. China, a similar position, similar story for their new export orders. They have been in contraction for 13 months, new export orders out of China. The Dutch have a wonderful data warehouse on global trade. And according to the Dutch Statistics Office, the real value of merchandise volume has now reached its third lowest point since 1991. Not the absolute value, but the growth in merchandise volume. And that's as far back as the series goes. So, nothing ever goes in a straight line, as a friend of mine says, and nothing is completely black and white. But it seems like the preponderance of evidence from these other markets sides with bond markets. There is something out there that is concerning all these economic actors, and the equity markets are in the minority. Now, I started out this show referencing The Economist and how they said the global economy is on knife's edge. That article had a byline right below it that said, mistakes by policymakers could topple it into trouble, the global economy. But I don't believe it's policymakers that are at fault or going to be the reason whether the economy goes into the positive or into the negative. I believe it's more of a function of what's happening with our global banking system, specifically our commercial banks. Now, the best example of this has been Deutsche Bank, the world's most important bank. They recently announced thousands of layoffs. Now, maybe you're not a fan of bankers or lawyers, but the banking system is how our current global monetary system creates the vast majority of money. And if these banks are struggling, then the wider global economy is going to struggle. And so what are commercial banks afraid of right now? Why are they hoarding collateral? Well, I think they're afraid of that an event like 2007 or 8 could take place again when good collateral, like mortgage-backed securities, are all of a sudden repudiated by the market. They could be afraid that in 2011 and 12, perfectly reasonable credit risk like Portugal, Italy, Greece, Spain, Cyprus, Dubai could become insolvent. They might be afraid that, like in 2014 and 16, the growth stories that are guaranteed for the next century, for example, China, could see their foreign reserves extinguished, just like China, which saw $1 trillion of its reserves extinguished. So since January 2018, we have seen this buildup of concern in liquidity by these commercial banks. And I think they're the ones that are favoring the bond market, and they're the ones signaling that there's something wrong out there. Now, there hasn't been a liquidity shock yet. There may never be, but I believe there is a crisis in progress in liquidity. And so, to see who will win between this argument between bond and equity markets, I want you to keep paying attention to leading economic indicators out of Japan, Germany, and China, the value of the U.S. dollar, and watch out for news about commercial banks. Are they doing better or are they doing worse? I think over the next few months, by the end of the year, we'll find out who was right, commercial banks, the bond market, or equity markets. Now, I appreciate you listening very much. We will be back in a fortnight. You can re-listen on the CFA Society Cayman Islands webpage. You can contact us via Twitter at Money Sense Radio, and I also can be reached at moneysense@cndw.ky. We'll see you in a fortnight with a new episode of Money Sense.
Money Sense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage.